ltsgroup.com, and you will be able to search all of our past recorded webinars. Presenting today is Mike Baker. He is the Director of Brokerage and Affinity Markets for Target Insurance of Pennsylvania. Mike will be discussing the long-term care products that are available. Also presenting today will be Joe Corio, who is the Senior Vice President of URL Insurance Group, and he also heads up our Annuity Solutions Department. Joe will be discussing single premium life products that are an alternative to long-term care products. If at any time during the presentation you have a question or comment, please type in the question on the box on the webinar control panel, and we will answer any questions at the end of the presentation. At the end of the webinar, there will be a poll that pops up on your screen. It's just going to be a simple yes or no question that you answer as to whether or not you would like us to reach out to you as a follow-up on any of our products, and either myself, Joe, or Mike will reach out to you. So at this time, I am going to turn the reins over to Mike, and he can get it started for us. Mike?
All right. Thank you, Karen. Hopefully everybody can see my screen. Should come up here as cover slide, financing long-term care. Does your client understand? So as Karen said, I want to thank everybody as well for taking time out of your busy day. What I'd like you to do is grab a pen and paper, and as I'm going through some of the material here, hopefully you'll have some clients that will come to mind that after this webinar, it's somebody that you should give a call to and follow up with. Inevitably, anytime we attend a workshop, a seminar, a webinar, we always think of that client that we should talk to, but then forget to write their name down or get into our daily routine after the webinar or seminar and forget to even contact the client. So as I'm going through some of this information, just jot down some client names, that you may want to follow up with when the presentation's over. So again, as Karen mentioned, I'm Director of Brokerage and Affinity Markets with Target Insurance Services of Pennsylvania. We've partnered with URL to provide all of the long-term care insurance, the traditional long-term care insurance back office support for anybody that's working with URL Insurance Group. We work in not just the individual marketplace, but if you have opportunities with associations, small groups, executive carve-outs, again, anything with related to the LTC market, we can help provide a solution. Again, just a quick snapshot of those services and support that we're able to provide, anything from quotes, pre-qualification, new business processing, if you need help with client conference calls, sales and training, etc. We're able to provide the full array of services and support that you're going to need to feel comfortable with when you're talking to your clients about long-term care. We provide a full product portfolio of all of the leading carriers that you're going to probably run into in the long-term care brokerage market space. Genworth, John Hancock, MedAmerica, Mutual of Omaha, Transamerica with the traditional products. And the other thing that we've most recently added to the product portfolio is a product called True Freedom. This is actually a non-medical and companion home care service. It's not a insurance product. It's actually a membership plan. There is no age limitation on this particular product. It is actually a field issue product. There is no underwriting. So when you run into some of those older clients that may not be able to qualify for long-term care insurance, or they've waited too long, or they may be in imminent need of needing some type of non-medical or companion home care service, this may be a solution that you can discuss with your client. So I'm not going to get into a lot of detail about this product, but as Karen indicated, there will be a survey question at the end. If anybody would like us to follow up and provide information on that particular product or any other products, just click yes and we'll definitely follow up with you. What we're going to just kind of touch on today is just give you a quick kind of LTC 101 review, talk about some of the responsibilities that as an advisor we have to discuss those risks and costs associated with long-term care, as well as obviously some of the solutions that the client has available to them. Touch a little bit on what's happened in the long-term care market in 2014 and kind of where does that leave us moving into the new year. Quick product update, and where do we go from there? So I know that many of you on the call may be working in the health insurance market or the senior market, and I always like to start at the beginning, and the beginning is really getting that client to just understand the difference between the acute care and the chronic care. So often our client has experiences that they may have had some type of an acute event where they've had to go to the doctor, they go to the hospital, get treatment, have a procedure done. If it's the type of an event where they're actually hospitalized and transferred to maybe a skilled nursing facility for rehab, that event has been covered by their traditional health insurance product or their Medicare product. So they are under the assumption that, oh, well, Medicare and health insurance are going to cover those types of services, so I don't have to think about long-term care insurance or a solution to what happens if that type of coverage doesn't pay for the services that I may need in the future. And really what we're talking about is what happens if that acute event occurs and I have a procedure or I get treatment, but it doesn't matter what happens with that treatment or that procedure, I still need care. And the care that I need is physical-based or it's cognitive-based, and it doesn't matter how much treatment or services I get, I'm going to need assistance for the rest of my life with some of those activities of daily living. And that's really when we're talking about the care becoming chronic in nature. And as many of you know, traditional health insurance, Medicare, have a natural gap in that coverage. It doesn't matter which plan that you provide to your client. Those plans just are not designed to pay for that personal or custodial care that individual may need on an extended basis. Good news is we're living longer. Bad news is we're living longer. So the longer we live, the more likely it is that we're going to need some type of care. And we probably have all seen, different odds in terms of different types of catastrophic events that may occur in our life, and anything from that house fire, to a fire in the home, to obviously the odds of needing some type of care. And the single greatest risk that we face as we get older is the risk of needing some type of care. 70% of those individuals turning 65 are going to need long-term care at some point in their lives. And today, as we all know, there's 10,000 Americans turning 65 every single day. So it truly is a kind of a tsunami of aging baby boomers that are turning 65, and it's going to present a real problem relative to individuals needing long-term care and how are they going to deal with those costs. As you can see, the vast majority of the care does not last longer than 5 years. Obviously, there are those catastrophic events, Alzheimer's, Parkinson's, where we've all known somebody that's needed care for more than 5 years, but the majority is less than 5 years. Costs continue to escalate. Again, just a quick map of the U.S. to give you a quick snapshot of some of the costs, the average costs of care across the U.S. As you can see at the bottom of the slide, these numbers are actually taken from the Genworth Cost of Care Survey that was most recently done in 2013. And obviously, when you get into the more metropolitan areas, obviously that's where you have, significantly higher costs for care. For those of us in Pennsylvania, this is actually a screenshot from the actual cost of care survey website. If you just Google Genworth Cost of Care, they do have a website dedicated to that where you'll pull up a map of the U.S. You can click on your state, select choose a location, and get a drop-down box with different geographic locations within the state. And you can check here on the cost breakdown to show these costs on an annual or a monthly basis so that you get a pretty good idea of what those average costs are for home health care, adult daycare, assisted living, and skilled nursing. The other nice thing is that it actually shows you what the 5-year annual growth rate in the cost of care has been for those different types of services in the geographic location that you're looking at. So you can also lay different geographic locations side by side, so when you're meeting with that client, you can give them a pretty good idea of what the cost of care is, not just where they're located, but maybe they're going to move to another area of the country, you know, maybe somewhere in the Carolinas, the Floridas, Florida, the Southwest, etc. So you can actually lay different geographic locations side by side, and you can also calculate the future cost of care because, again, it's not just what is that cost of care today, but what's that cost of care going to be 10 years, 20 years, 30 years down the road. And when you look at what those costs of care are today, we all know that it's very expensive today. But from a planning perspective, I also need to be thinking about what are those costs when the likelihood is that I'll need care 10, 20, 30 years down the road. So that Genworth Cost of Care Survey can be a pretty good tool for you to use when talking about costs of care with your client. We all know that basically there's only so many different ways that you can pay for care. Medicare will pay for some skilled nursing care, but obviously that is very limited. Even in a best case scenario, you're looking at 100 days of coverage for skilled nursing services. Medicaid will pay, but again, that's means tested, so the individual is going to have to spend down their assets in order to qualify for Medicaid. And for many of your clients that you're working with, the likelihood that they may get to a Medicaid scenario may be very, very remote. And even if it's not remote, the likelihood that they want to have to spend down their assets or deplete their assets in order to get to Medicaid is probably something that's not very appealing to them. Medical, as I mentioned previously, medical insurance, disability, obviously aren't designed to cover long-term care insurances. So from a insurance perspective, Medicare, Medicaid, while there is some limited coverage, they're usually not what most folks are going to be able to rely on. Individuals can self-insure through private pay. When we get to a few minutes from now, you know, Joe is, Karen mentioned, Joe Corio is going to address some of the solutions that are available for individuals that may want to think about potentially self-insuring as an option, which is going to be a much more effective and efficient way by transferring some of that risk to an insurance company versus paying for it dollar for dollar out of their own pocket. And then obviously we have the traditional long-term care insurance that can kind of fill in that gap. So as I mentioned earlier, when you talk about, doesn't matter how good the Medicare plan is, doesn't matter how good the medical plan is, those plans just are not designed to pay for personal or custodial care, which 95% of all long-term care services are personal or custodial care. So it's obviously a big piece of what is a gap in an individual's insurance coverage. Interestingly, you know, John Hancock actually did a survey of their existing policyholders, and 83% of their policyholders indicated that they were the one that had to ask their advisors first about long-term care. Our agency, Target Insurance Services, the PA, is a managing general agent. You know, as I mentioned, all we do is long-term care. I can tell you that the average broker probably sells about 3 to 5 long-term care insurance policies a year. Typically, it's when their client asks them if they can sell long-term care insurance. So seeing these numbers with the survey that John Hancock did is not completely alarming because I know that, unfortunately, a lot of advisors take a more reactive role when it comes to selling long-term care insurance. Interestingly, though, you know, I'm going to jump to a slide and then come back to that one that I just skipped over. AgeWave and Harris Interactive in January 2010 did a survey And 86% of men and women say that it's actually important for their financial or health insurance professional to talk with them about long-term care, yet only 9% have had their financial professional talk to them about long-term care. So the question I pose for you, for those of you that are on the call with us, what is your responsibility? What is our responsibilities as agents or advisors with our clients that view us as their trusted advisor relative to discussing the risks that they may face in the future. And when we look at the risks and costs associated with extended medical care, i.e. long-term care, nothing has changed. The risk is still the same. The costs are going to continue to increase. And the costs associated with extended medical with an extended medical care event is still the single greatest financial risk that your client faces that they most likely have not addressed. So regardless of everything that's happening, and again, we're going to talk about some of the changes that the carriers have had recently in terms of repricing, underwriting changes, etc. Regardless of everything that's happening from a carrier perspective, the risks and costs associated with an extended medical care event are still the single greatest risks that your clients face. And because there are so many different solutions that your client has today, I think we have an obligation to at least have that conversation with your client. And what I wanted to show today, one of the things I wanted to illustrate for you today was if your client had a portfolio, a $2 million portfolio, and let's say hypothetically that over a 30-year, even over a 30-year period of time, they withdrew $100,000 annually from that portfolio. We take into account, market returns, the good, the bad of those market returns. Even after a 30-year period of time, you can see that their retirement account, even with taking $100,000 a year out of that $2 million portfolio, they're still going to have a substantial nest egg left over. That's assuming that they've not had any type of an extended medical care event. Let's say that hypothetically, beginning in the 15th year of that 30-year time frame, that they have a major illness in year 15. And in year 1, they have 44 hours a week of home health care. Now again, obviously this is taking into account the increases in the cost of care from where it is today to what those costs of care would be 15 years from now. In year 2, there's an increased need for care. So now they've doubled their cost of care. They're obviously doing everything within their financial power to be able to, for that individual to be able to remain in their own home as long as possible, and they double their care that they're getting. It's now 88 hours a week in year 2. And in year 3, it now goes to 24-hour-a-day care. And you can begin to get a sense of what's happening to this portfolio. And in year 4, they wind up having to transition to a nursing facility. So after a 4-year event, beginning in year 15 of this 30-year time horizon on this $2 million portfolio, you can see that it obviously has a dramatic impact on that portfolio and pretty much devastates what's left in the portfolio, not only to pass on to their on to their heirs, but if there's a spouse at home, how it's going to substantially impact that spouse at home. So, again, I go back to, regardless of everything that's happening from a traditional long-term care insurance perspective, which obviously, can create concern for all of us when we're addressing what those options are for our client. I would pose to you the question again, having that conversation with your client relative to a planning discussion, which is consistent with the other conversations that you're having with your client, centered around a planning conversation as opposed to a product conversation, the best way to start that conversation is simply to pose to your client, if you were to get sick and need assistance for an extended period of time, what would your plan be? And find out what their plan would be if something were to happen. And most importantly, how would they pay for it? What is the financial solution that they have to be able to pay for that plan? So focus on the plan, not the product. Obviously, personal experiences are a motivating factor, but ultimately the plan objective is very straightforward. The plan objective is to maintain the client's independence in the community while preserving the emotional and physical well-being of those who will provide the care, and preserving the retirement portfolio so it can continue to support the lifestyle and keep the financial obligations of those who are dependent upon it. You know, in terms of the plan design, again, does your client really need to cover 100% of the cost? Most likely not. What we typically see is somebody purchasing a benefit or looking at a starting benefit that's somewhere between 50 to 75% of the actual cost of skilled nursing care in their area, because 50 to 75% of the skilled nursing cost in terms of a benefit is probably going to cover the majority of home care or assisted living costs, which is where most people are going to get services if something were to happen. Also, keep in mind the long-term care partnership program, which obviously provides the ability for the client to protect assets equal to the benefit that's paid out by their long-term care partnership qualified policy. What I'm beginning to see more advisors do is to have some type of a CYA document, a hold harmless agreement or form that when they have that conversation with the client, maybe make some type of a recommendation in terms of a planning option, and that client declines to take action at this time, that the advisor is simply having that client sign some type of a CYA document so that they're able to document that, yes, we had the conversation, I recommended this action, but the client declined at this time, so that if something were to happen in the future, mom or dad need care, mom or dad go through the kid's inheritance, you're at least able to go back and document that I did have these conversations, I did make these recommendations, but mom and dad chose not to take action, so that when the parent or when the kids come back to you as the trusted advisor to say, why didn't you recommend to my parents who had this portfolio to not take any type of a planning action, you're able to at least provide the documentation that yes, you did. However, they chose not to do anything at that time. So what's happened in 2013? Again, you know, we've seen the traditional long-term care market was down considerably, but there certainly has been an increase in availability of alternate solutions. You know, be that with a hybrid solution, or with a long-term, or with a life product with an accelerated rider. Those are certainly gaining a lot more traction in terms of alternate solutions to a traditional product. With the traditional products, you know, again, gender-based pricing was probably the most significant thing that's taken place in the market. Single females today, with most of the carriers, are paying anywhere from 50 to 60% more as a single female than they were a year ago at this time. And we're seeing the carriers try to develop and implement or offer different types of plan designs, different inflation options, so that we're able to still design products with a meaningful benefit, but a premium that's affordable for the client. For those of you that may be working in the multi-life space or the group space or with business owners, there's a lot of opportunity in the multi-life space. While we've had a consolidation in that market in terms of the number of carriers, we still have several carriers that do offer multi-life platforms where we can get some abbreviated potentially some abbreviated underwriting, but more importantly, we're still able to use unisex rates in those worksite markets. So that's a real opportunity, again, for females through an employer to be able to purchase long-term care insurance at a substantial discount. Can be very appealing depending on the business. And we're seeing an increase in technology. Obviously, more carriers are developing the ability to complete applications online, or for advisors to actually be having these conversations with clients and doing business over the phone, through the mail, through screen sharing types of technology, so that not only can you do business with somebody that's sitting across your desk, but somebody that's literally across the country. You can be talking to them about long-term care and what their options and some of the solutions that may be available for them should they want to do something. Biggest impacts that we've seen in terms of what's caused some of the changes with regards to the cost has been, the interest rates. Obviously, it's impacted a lot of us in a lot of different ways. But the interest rates have really been the biggest thing that's impacted the traditional long-term care products, and has obviously had some impact on the life side as well. And Joe can probably touch on that on the life side better than I can. Lapse rates, claims experienced, increased morbidity. Again, all of these things are factors that have led to some of the more recent changes in terms of pricing, restructuring that some of these carriers have had to make in terms of the products that they're offering. So what I'd like to do at this time, Joe, if you're ready, I'd like to pull up your slides.
I'm ready, Mike. Can you hear me?
I can hear you.
Okay.
There you go.
Okay. Hello, everyone. And thank you, Mike. Very good information so far. And obviously, when you come across the potential for preparing for somebody's future, long-term care plan should be the first option. But sometimes that doesn't always happen. So it's very important to have single premium life either as a complement or as an alternative to long-term care coverage. And one of the reasons for that, as many people think single premium life is just a wealth transfer tool. However, it does play a big part in providing an answer to possible long-term care objections. A lot of times, long-term care prospects may feel that the coverage is too expensive for them, or they may be paying premiums for coverage that they'll never lose. I'm sure you've heard, never use. I'm sure you've heard it before. They say, boy, that's a lot of money, $6,000 or $7,000 a year, or whatever the premium is for a long period of time. Suppose I, get hit by the bus and never need long-term care. So there is a lot of apprehension out there. So single premium life provides a great answer to that objection. And a lot of times prospects won't want to submit to full underwriting, exams, bloods, APSs, and so forth. With single premium life, it's easy to apply for. It can be applied for with an application taken by the agent and a phone interview, which the agent and the client can conduct with a third party. So it's really quite easy. Most coverages are turned around in about 48 hours with some of our carriers. We have about 5 carriers that offer single premium life with enhanced benefits. But the big thing is when you're dealing with underwriting for this type of policy, life insurance is much different than underwriting for long-term care coverage. Life insurance is underwritten for mortality. So a lot of times we have clients who have been rejected for long-term care coverage, and we apply with them for a single premium life, and they get approved within 48 hours. And the agents are always amazed by how this works. Well, the reason is it's underwritten differently. So we're looking for mortality here. So just to show you how it works, Mike, if you put up that screen, there you go. This is an example, female 62, assuming she has $50,000. And like Mike said earlier, a lot of people do self-insure for long-term care. So they might have money in a CD, and we'll go through some of this. But let's just say this client had $50,000. Upon issue of this plan, her guaranteed death benefit would be $98,000, and the non-guaranteed, and that's based on an index tied to the S&P 500, would be $132,153. That's day one. Now, in Pennsylvania, this policy has no waiting period. So immediately, the client would have a benefit for terminal illness, and nursing care benefit, or chronic care, which is home health care. The inability to do 2 out of the 6 activities of daily living would kick this benefit in. And the numbers you're seeing here to keep the companies and the insurance department very happy, we're using the guaranteed death benefit of $98,000. And you can see under the nursing care benefit and the chronic illness benefit, we have $97,750 of benefit. That's because if you do exercise this option from your life policy, there is a one-time $250 policy fee. So we're taking the benefit minus $250, and we're showing here again the guaranteed benefit. The best thing is, though, in reality, we always work off the current death benefit. So this client, 62 years old, once the policy was issued, would really have a benefit of about $131,900. That's the $132,153 minus $250. So all $131,903 of death benefit can be used for nursing home care or chronic illness. Now, the nursing home care is a 3-year benefit, so we just take that current death benefit and divide it by 36 months for a monthly benefit. And the chronic illness benefit is a 5-year benefit, so we take that death benefit, subtract out the $250, and divide by 60. So it's a real easy formula, and the client can use it anytime. And again, to answer the LTC objection we hear often, if they don't use it, the entire death benefit goes to their beneficiaries tax-free. And that's a phrase which every senior loves to hear, because the more you talk to people, the more they don't want to leave any tax burden to their beneficiaries. So Mike, if you flip that page, we'll just look at a few of the sources quickly here of single premium life. You might think, well, I don't have clients who have that kind of money. You would be surprised. A lot of people do self-insure, so they have money in their savings account or in CDs set aside just in case they do need long-term care coverage. They don't want to burden their families or turn to friends, so they self-insure. Well, we can take a portion of their self-insured money, use it for this type of policy, and free up a lot of money for them to use whenever they want. Also, a lot of people have old life insurance policies that have cash value. It's not uncommon for us to get a call where a client has $50,000 of death benefit and maybe $30,000 of cash value in there. They don't really want the policy anymore, and we always suggest, look, don't cash that in. Just do a 1035 transfer. You'll use your $30,000 cash as a premium. You'll have a new death benefit. You'll have no ongoing premiums, and you'll have the benefits for home health care and home health care and nursing home care that you don't have right now. And there's also a lot of underperforming investments out there, a lot of mutual funds that people aren't happy with, a lot of variable annuities and so forth. So there's a lot of ways you can fund single premium life. And Mike would be glad to go through that with you, or you can call our office and we will also be happy to go through the single premium life option. But it's really something you should have if you're talking long-term care coverage. As Mike just pointed out a few minutes ago, not enough of us are talking long-term care coverage with our clients, and we need to do more because that's what they want to hear about. So Mike, I'll turn it back to you.
All right, thanks, Joe. I just changed presentations back over here, and again, just echo everything that Joe said, and that's kind of why my suggestion to an advisor really is to try to talk more from a planning perspective as opposed to a product perspective, because that keeps the single premium life, the hybrid, the traditional products, it keeps everything on the table. And really, again, it's about going back and doing the best job for the client and selecting the solution that is going to be best fitted for their particular needs. But again, going back to the traditional products, as I mentioned earlier, the biggest change that we've seen has been the gender-based rates. Genworth, Hancock, Trans, America, Mutual of Omaha have all implemented gender-based rates. And when you look at the fact that 70% of all long-term care claim dollars are spent on females, it helps to put into perspective of why carriers today are beginning to reprice their products more appropriately from a risk standpoint. And you can see some of the other bullet points there relative to the risk that that a female presents to an insurance company from a long-term care perspective. Having said that, MedAmerica is continuing at this time to use unisex rates. We've had no indication that they are going to go to a gender-based pricing table, but that's not to say that they won't. But at least in the interim, with regards to single females, they are priced very attractively because of the fact that they're still using those unisex rates. Some of the changes that Genworth made, again, probably the biggest adjustment with Genworth beyond just the gender-based pricing is the fact that they've now gone to more life insurance-like underwriting. So they are requiring a paramed exam, lab work with all of their applicants for long-term care. So, you know, again, if your client is adverse to the life insurance type underwriting, Genworth is probably not the direction that you want to go. Having said that, it has permitted Genworth to expand their rating classes, so they do offer preferred, preferred best, select, and standard, so they can be a little bit more precise in their underwriting. So again, you know, it's definitely a good news, bad news scenario. The other thing that we've seen kind of throw agents a little bit is the fact that they've changed or reduced their max issue age down from 79 to where their max issue age now is only age 75. So if you have a client that's over the age of 75, Genworth is definitely not going to be an option. Transamerica, you know, again, some of the changes that they've made, and I'm not going to go through all of these things point by point, but again, the big change that they've had is, again, the gender-based rates. They have changed some of the discounts. And again, what they've also done was expanded the number of inflation options that are available so that, you know, we can maybe get to a little bit broader market. Again, providing that benefit that's meaningful, yet a premium that's affordable. Mutual of Omaha's changes are probably some of the more recent changes. Again, Mutual of Omaha had a long-term care portfolio, as did United of Omaha. They have consolidated that, so everything is being sold under the Mutual of Omaha brand. There are two different products, Secure Solutions and Custom Solutions. For those of you that were selling the United of Omaha products, were probably the Mutual Care Solutions would be more in line with what you would have been familiar with under the United of Omaha brand. Secure Solutions is more consistent with what we were offering under the Mutual of Omaha brand. MedAmerica, actually they've had a consolidation as well within their product portfolio. They did have 3 products. They now only have 2 products, FlexCare and Transitions. They previously had a product called Simplicity that was that's no longer being offered. The FlexCare product is a reimbursement product, but it does offer a rider that you can turn that product into a cash, a 100% cash benefit for home health care and assisted living, so that if you have that client that is concerned about or does not like reimbursement policies because they don't want to have to incur that expense and then be reimbursed, MedAmerica actually gives them the option where they can add that rider, turn the policy into cash, and when they trigger the policy, Client gets a check at the beginning of the month for the full benefit amount. It's cash. There's no limitations of how they spend those dollars, so they don't have to worry about reimbursing actual expenses. If they have a family member that wants to provide that care, because it's cash, they can spend those dollars how they want. Again, they're using unisex rates, so in the multi-life space, as well as obviously in the individual space, those rates can be fairly attractive. They still also offer a limited pay option, a 10-year pay, and a 20-pay option. If you have clients that may be returning to their homeland, the MedAmerica policy has no limitations in terms of foreign coverage. So whatever their benefit is here in the U.S., they have that same benefit, 100% benefit available for foreign coverage as well. So that can be, that can be attractive depending on who the client is that you're working with. Again, just quick claims, some claims numbers. These claims figures are from Genworth, and I just highlighted or in white font some of the more interesting claim statistics that may be helpful for you when talking to clients. So again, 70% of all claimants are females. 15% of all claims lasted more than 5 years. The average length of claims, if one claimed for more than 1 year, was 3.9. 71 started as home care, 13% started as assisted living, and 50% of claims that lasted less than 1 year, so obviously 50% lasted more than 1 year. But I think this goes back to one of my earlier comments that, again, in terms of a benefit design, it's trying to find that balance between a benefit that's meaningful and it's a premium that's affordable. What we typically see, again, is an average plan, $150 to $200 a day, maybe between 3 years and 5 years in terms of a period of time. And again, the benefit increase is just going to be somewhat age dependent. But, that $150 to $200 a day seems to be where the majority of benefits fall, and that 3 year to 5 year. And if it's a couple, most couples add a shared care rider, allowing each other to access, the other individual's benefit if needed. So again, some of the keys to success really is just having that conversation. Those two questions that I talked about. If something were to happen where you got sick and needed some type of extended medical care, what would your plan be? And more importantly, how would you pay for it? Plan design. Again, profile the client. It's consistent with make it consistent with the planning conversations that you've had with your client relative to life insurance, relative to asset management, relative to health insurance. The conversation centered around the risk and cost associated with extended medical care is simply an extension of those conversations that you've already had with the client. In terms of carrier selection, you don't have to be the expert. That's what we're here to do. All we do is LTC, day in, day out. If you're not comfortable with or not sure about a carrier, not sure about underwriting, get some of that basic medical information, height, weight, tobacco, medications, hospitalizations, things of that nature. Give us a call. We're not predisposed to a particular carrier. So when we get that information, we'll qualify with all the carriers, give you 1, 2 carriers to take back to your clients so you can show them that you're doing the due diligence. If it looks like, if you call us first and it looks like traditional long-term care insurance really isn't going to be the solution based on the conversation that we're having, we're going to redirect you back over to Joe so that he can maybe talk to you about what those hybrid or life options are so that, again, you can go back to your client with a solution. But be patiently persistent. Again, don't just get the long-term care insurance quote, whether that's traditional single premium or whatever the case is. Show it to the client. If the client tables the conversation for now, make sure you follow up. follow up on a regular basis, every couple of months, 3 months, every 6 months. Make it part of an annual review process, because inevitably, while today may not be the day that the client wants to take action, when they have a personal experience, they're going to understand what those costs are, the impact that it has on the family, and they're going to be more likely to want to begin to openly and actively seek out what their options are from a planning perspective. So it's going to take more than one conversation, and you just have to continually educate and inform the client about their options and the fact that you can be there as that resource. You don't again, you don't have to be the expert. We can provide all of the services and support that you need personally to work with that client if you're comfortable with long-term care. If you're not, we can be on the call, we can be on the phone with you when you're talking to the client, so that you don't have to be the expert. You can rely on us. That's what we're here to do. That's the relationship that we have with URL. We're going to provide all the services and support that you need, whether you're going to do it yourself or you want us to assist you while you're with the client. The third option, what we're finding some agents recognizing, is that they don't want to be, they really don't even want to be involved in the conversation. They really just want to be able to have an outlet or a resource that they can refer the client to. And you can refer the client to us. We do all the work, and you still get paid. We do it on a split commission basis. Again, we can talk about that offline, but again, you can make sure that your client is being taken care of, and we will do, again, we'll do all the work, and you still get paid. Just a couple upcoming trainings that we have. March 6th, for those of you that are local here in the greater Harrisburg area. We're going to have Brian Shepard, who is our regional vice president with Genworth, in to do a long-term care insurance practice management program. This is really designed for the independent financial professional, like those of you on the call who are really looking to grow and develop their practice maybe beyond what they're doing, looking for some additional lines of revenues, or just, again, being able to better service their clients. Brian's going to walk us through a practice management program that Genworth has developed to be able to integrate long-term care into your practice. That's going to obviously be a physical classroom workshop, but at some point here in the future we will be doing a webinar version of that, so we'll keep you posted on that. Also March 10th, we have a Mutual of Omaha webinar. Underwriting is becoming more of a challenge, so we are doing a webinar with Demary Bond, who's the chief underwriter with Mutual of Omaha, to give us a better perspective on that particular carrier's underwriting philosophy, and maybe better frame your expectations from an underwriting perspective, so that you can also frame your client's expectations relative to the process. And I also do a newsletter every week where I take all of the carrier newsletters, condense them into one, keep that out in front of everybody, just to keep everybody posted on, kind of what's happening in the long-term care market space, as well as any trainings, webinars, meetings, etc. that we're doing. So in summary, again, the only constant we've really seen over the last probably 12 to 15 months in the long-term care market has been change. While those changes obviously can be frustrating on a number of different levels for all of us, both us as advisors and as clients, they really are prudent steps that the carriers are taking to better price those products, not only for today but in the future. And regardless of all of those changes, long-term care is still the single greatest risk financially that your client faces, and they probably have not yet addressed. The takeaway is that whether it's a traditional product, a hybrid product, a life product with a rider, there is a solution that probably is out there for your client. It's just a matter of having that conversation and knowing that when you're having that conversation that you don't have to be the expert. You just have to be comfortable knowing that there is a resource behind you, be it through URL, or through our offices here at Target of PA, that we can give you the confidence and comfort that you need to have those conversations with your client to make sure that they're being taken care of the best way possible. And again, just be patiently persistent with any conversations, that you're having. So I'm going to leave that. I'm going to leave that screen up for right now, and kind of turn this back over to Karen or Jim or Joe to see if there's any questions that anybody may have at this time that any one of us might be able to answer for you.
Karen?
Sorry, thought I was unmuted. Thanks, Mike and Joe. We do have a few questions here. The first one is from Sean. He is asking if we can get a copy of the presentation.
Yes, I know, Jim. I can provide these slides over to you so that you have them to. We can either send them out to everybody or post them on the website, whatever you see as the best option.
Okay, thank you. The next question is from Arthur. He is asking, with the debacle of the Affordable Care Act, do you think this will affect long-term care planning and purchase, or do you think the general public is going to expect their government to also cover long-term care?
That's a great question. I think historically folks have been confused and thought that the government was going to pay for long-term care. There was a program within the class or within the ACA called the Class Act that was actually designed to be a federally run long-term care insurance program that was actually repealed out of healthcare reform. So while individuals may be under the impression that healthcare reform has some element related to long-term care, any inkling of a long-term care program within the healthcare reform was actually repealed. And again, I think that just goes back to my comments, Arthur, about the importance of just educating and informing your clients about what does and what does not pay for long-term care and what options they have that are available to them.
Okay, the next question is from Joseph. He wants to know if a client in the single premium life example progresses from home health care to nursing home care, how does the formula work?
Good question. The formula does not change. So if they start with home health care, they're going to have to stay with home health care. So what we always suggest is if your client looks like they're going to go into nursing home care, what you can do is you can take a free withdrawal of the policy. It allows for free withdrawals anytime after the first year. So that might be able to get you through while they're at home. And then once they do go into a nursing home, you can exercise that option. If you start it with the home health care and they go into a nursing home, you can continue it, but you're going to get the 1/60th payout rather than the 1/36th payout.
Thanks,
Hope
Joe.
that helps.
And Joseph, again, has another question. He's not familiar with MedAmerica. Do you recommend them? Do you know what their financial strength rating is?
With AM Best, they are a B+ rated carrier. They have been in the long-term care market for a little over 25 years. They are actually a subsidiary of Excelis, Blue Cross Blue Shield. As I mentioned, they only do long-term care insurance. We are comfortable with them. If we weren't comfortable with them, we would not include them in the product portfolio. And part of the reason they've kind of flown under the radar is about half of their business historically has been private label business, meaning that they have actually underwritten about 20 or so different Blue Cross and Blue Shield offerings across the country. So for example, here locally in the central Pennsylvania area, Highmark Blue Cross and Blue Shield offered a long-term care insurance product at one time. While it was on the Highmark Blue Cross Blue Shield paper. It was actually MedAmerica's product. So MedAmerica has done a fair amount of private label, so they kind of fly under the radar, and is why they're not as commonly recognized as some of the other carriers. But yes, we are very comfortable. We are very comfortable with them as a option. If you or the client is not, that's why we have a full portfolio of carriers available to work with.
Okay, and Joseph also wants to know, do you do any work in the area of Medicaid and or aid and attendance planning?
No. And the reason I say that is because there's a fine line between being able to give your client a basic understanding of Medicare, Medicaid, and what it takes to get to a Medicaid scenario. While I personally am an instructor for the long-term care insurance partnership programs, I never recommend anybody get too deeply into Medicaid planning discussions. My suggestion is always to have a client consult with an elder law attorney relative to those types of planning options. No differently than if somebody got into a lot of tax questions, I would always refer them back to their tax advisor for any tax-related questions.
Okay, and Michael is asking, is there an interest rate cap on the single premium life?
Yes, there are caps. There are very high caps because, like any life policy, there are some mortality charges and so forth associated with it. So that means the carriers do not have to rely on an interest rate spread to make money. So, for instance, on one of our more popular plans, the 1-year point-to-point is 8.5%. Even the fixed rate is 4.2%. And they have a 2-year average cap that has no maximum at this point. So you'll find the caps are much higher, which means more gains available, and as the gains are added to the policy, that means the death benefit increases, and as the death benefit increases, the living benefits increase. So it makes it a pretty good situation.
Okay. Peter commented that the MedAmerica parent company is an A- rated company. And then our final question is from Glenn. He is asking, where can he find documentation on what Medicaid will pay and when, so that he can drive home the point that self-insurance without a plan like this is risky?
Mike? Oh, I'm sorry.
Mike?
I had my phone on mute.
Oh.
Sorry about that. Yeah, if he wants to reach out to me individually, I can provide some documentation on, the basics of Medicaid spend down. It's a little bit more complicated to get into, so the best thing for him to do would be just to reach out to me, and I can provide that information.
Great. And that is the last of our questions. So Joe and Mike, thank you so much. Very good information.
Thank you.
And like Mike mentioned, if you are in the Harrisburg area next week on March 6th, we will be having a lunch and learn with Brian Shepard from Genworth Long-Term Care. That will be starting at 10:15 in our office in Harrisburg, Pennsylvania. You can go to sign up for that event on our event calendar on our website, which is urlinsgroup.com. And I will show you the website in 1 second. I can get there.
Hey, while Karen's bringing up the website, for anybody still left on here, if you'd like us to follow up with you after this webinar today, please go ahead and click yes on the poll that's on your screen. If you don't want us to bother you and you got all the information you needed out of this webinar, please click no. We know your time's important and we don't want to bother you if you're not interested. So I will go ahead and close the poll here in a second, but Karen, are you ready to show the website?
I'm ready to show it. Yep, I was just going to say I can't do it because the poll's open.
Okay, I will close the poll now.
There we go. Can you see it?
Yep.
Okay, great. So here is our senior care products page, and if you click on the long-term care on the left-hand side there, you will see Target Insurance Services of Pennsylvania, and you can click to get a quote, and here are all of the newsletters that Mike had mentioned in the webinar. For your reference, the Annuity Solutions page where you can contact Joe Corio or Maria or Tony. And if you go to the home page, here is all of our upcoming events, and you can click on there to see our event calendar. And if you go 1 month over, Jim, is it showing? There it is, the Genworth Long-Term Care Lunch and Learn. You click on that, and you can fill out the form and register yourself for the event. If there's any questions, please feel free to give myself, Joe, or Mike a call. Again, thank you so much for taking time out of your busy day. We really do appreciate it.